Before you list your North Texas home, there are two numbers you need to know: $250,000 and $500,000. I'll help you understand the real estate side, estimate your potential equity, and organize the questions you should take to your CPA. Because the smartest time to discover a potential capital gains issue is before you list, not after the settlement statement lands in your inbox. I'm Kelly Pearson with Monument Realty, helping homeowners across McKinney, Allen, Frisco, and North Texas make smart selling decisions before the sign goes in the yard. Today, I'm breaking down the home sale capital gains rule that sounds simple until you actually run the numbers. This is general education, not tax advice. Have your CPA or tax attorney review your specific situation before you sell. Under current federal rules, a qualifying homeowner may exclude up to $250,000 of gain from the sale of a primary residence. For a married couple filing jointly, the exclusion may be as much as $500,000. Notice I said gain, not sales price. Selling an $800,000 home does not mean you have an $800,000 capital gain. Thank goodness, because that would be a very different video. Your gain is generally your amount realized from the sale minus your adjusted basis. In plain English, start with the sales price, subtract qualifying selling expenses, and then subtract what you invested in the property, including the purchase price and certain qualifying improvements. Here is where sellers get tripped up. Your mortgage balance does not determine your capital gain. Your mortgage affects your equity and the cash you receive at closing. The federal gain calculation focuses on your amount realized and adjusted basis. Equity and capital gain are related, but they are not the same number. Let's say you bought a North Texas home for $450,000. You later completed $75,000 in qualifying improvements that are still part of the property. Then you sell for $850,000 and have $50,000 in qualifying selling expenses. Here is the simplified math. An $850,000 sales price minus $50,000 in selling expenses gives you an $800,000 amount realized. Subtract a $525,000 adjusted basis, and your estimated gain is $275,000. For a qualifying single filer, the first $250,000 may be excluded, leaving about $25,000 potentially taxable. For a qualifying married couple filing jointly, the entire $275,000 may fall within the $500,000 exclusion. Same home, same sale. Very different potential tax result. The basic IRS test is usually this: you owned the home for at least 2 of the 5 years before the sale. You used it as your main residence for at least 2 of those 5 years. And generally, you did not claim the home sale exclusion on another property during the prior 2 years. For married couples filing jointly, either spouse may satisfy the ownership requirement, but both spouses generally must satisfy the residence requirement to receive the full joint exclusion. Exceptions and partial exclusions exist, but a 5-minute YouTube video is not replacing your tax professional. Certain capital improvements can increase your adjusted basis and potentially reduce your gain. Examples may include additions, a new roof, kitchen modernization, flooring, a swimming pool, major systems, or other qualifying improvements that add value, extend the property's useful life, or adapt it to a new use. Routine maintenance and basic repairs generally do not count the same way. So keep your invoices, receipts, permits, purchase documents, and settlement statements. That boring paperwork may suddenly become very interesting. Pause before using the basic formula if the home was ever used as a rental, used for business, inherited, or received as a gift, transferred during a divorce, or connected to depreciation deductions. Those facts can change your adjusted basis, create depreciation recapture, or limit how much gain can be excluded. That is why I want sellers looking at these numbers before we choose a list date, not after they are already under contract. You may have heard that Congress is considering changes. One proposal would double the exclusion to $500,000 for individuals and $1 million for married couples filing jointly. Another proposal would temporarily allow up to a $1 million exclusion for certain homeowners age 65 or older who have owned their primary residence for at least 25 years. Interesting? Absolutely. Current law? Not yet. As of August 4th, 2026, these are still proposed changes. Until legislation is actually enacted, sellers should plan around the current $250,000 and $500,000 limits. Your first step is getting a realistic equity check based on recent neighborhood sales and current market trends. Use the free equity check link in the description, subscribe for more North Texas seller strategy, or text me at 720-281-3640. You can also comment equity below and I'll help you get started. When you reach out, have 4 things ready: what you originally paid for the home, your estimated selling price, records for major improvements, and whether the property was ever rented or used for business. I'll help you understand the real estate side, estimate your potential equity, and organize the questions you should take to your CPA. Because the smartest time to discover a potential capital gains issue is before you list, not after the settlement statement lands in your inbox.